Last question here. It's probably a good one to ask, considering we've been pretty loud on this for the most part of the year. But what do you have a view on high yield at this point and then moving forward?
Yeah, no, we haven't. Of course, still negative.
Yeah.
We haven't. So that's one of the more important things we can take away. So
yeah, I think we've tried to comment on this a lot recently.
So there's
it's notable.
What chart is that on the slide deck? Maybe
34. Yeah.
34.
Depending on which one you're looking for.
No, my apologies, guys. Slide 28 of the macro deck. So in this slide 28, we're just showing just a composite of the senior loan officer survey data. And when, again, from our Q1 macro themes deck credit cycle, we did a whole deep dive on the domestic credit cycle and where we were in terms of contextualizing, that cycle broadly. And we're just getting started. I mean, this chart always mean reverts much higher.
Yeah.
Credit is getting tighter on the margin in the U.S. and it's going to continue to get tighter on the margin in the U.S. You're going to continue to see bankruptcies accelerate. I want to say April was the highest month of bankruptcy since November of 2009.
Yeah.
That's definitely accelerating on the wrong side, with like 50 to 60% of it being resources firms. So obviously, almost half not being resources firms.
Well, most of it. I mean, the one thing to point out. Sorry to interrupt you, but in like the consumer space, even in retail, there are tons of bankruptcies. So to think that, and that's one thing that we don't expect to be different, is the bankruptcies flood to all different sectors.
Yeah.
Every cycle. It's not just resource. It's not like, once you see this bottoming in commodities or something, depending on when it happens, if and when it happens, that all this credit is going to be eaten up and commodity prices are going to go up and companies are going to be able to pay off debts. I mean, usually the cyclical nature of this is that you see this tightening and these bankruptcies in every sector. Yeah,
well, capital markets are reflexive. So I mean, if you have one sector of the economy imploding, a senior loan officer or an investor who's allocating money to high yield assets or something is not going to say, well, I'm just going to give it to this guy.
Yeah.
No, they're probably going to say, well, the economic conditions are deteriorating. Maybe I should tighten the spigots up a little bit on the margin, and that permeates throughout the broader economy. We showed that on slide 35 of our Q1 themes deck, which is delinquencies on an aggregate basis, delinquencies within the mortgage market, and then delinquencies within C&I lending.
Yeah.
And then what you're seeing is that each cycle is different in terms of what leads the broader rise in delinquencies, but every cycle is the same in that they always snap back to each other because they always spread and permeate throughout the entire economy as credit tightens and deteriorates. And we're seeing that. I mean, obviously, this is just one. The senior loan officer survey data is just one indicator, but you're seeing it reflected in capital markets. I mean, high yield issuance down 45-50% year over year. Equity issuance down 45 to 50% year over year. M&A just can't get done. I mean, you have one-off headlines, but I mean, we're definitely well off peak in terms of M&A as well. So the credit markets are deteriorating, and default rates are going to go up. And if energy doesn't continue to just rip from here, even if it just stays flat, the rest of the rest of the sectors within the high yield market are definitely looking worse today than they were even a year ago.
Yeah.
So definitely still negative.